Joining me this morning on Investing 101 is Mark Horner, who is the founder of Fairhaven Wealth Management. Thanks for coming in today.
Thanks for having me, Fritz.
So you have a topic here that probably can affect a lot of us, and that is overconfidence in investing. Now tell me, give me the definition of that. I mean, it should be pretty obvious, but go, shoot.
Well, so yes, as human beings, we're all guilty, I think, of overestimating our abilities, and that's true both in investing and in the real world. So 90% of people generally cite themselves as above average drivers. College professors the same way, and I think probably most people watching have been in cars with men at the wheel that are trying to get somewhere without a map, and they get themselves lost. So it happens throughout the world, not just investing.
And see if we'll use a full screen there. Specifically when it comes to men, I know that of course men, myself included, will want to say that we know where we're going. Ignore the passenger, and that's exactly the statistics that you found out.
So it's bad news for us, Fritz. Men are horrible at this, both behind the wheel and in investing. So women have us beat, hands down. Every survey says this.
Specifically with men, it's not just that we're overconfident. There's some examples of this. Tell me.
So absolutely. Vanguard did a study in 2010 and looked at the activity of investors dealing with the financial crisis in 08 and 09, and conclusively, men, 2 to 1 ratio, sold more frequently at the bottom than women did.
Well, of course, we could play that too. That might be an interesting market play, but we'll not go into that today. But now, amateurs versus professionals. So we're not just talking about the real amateurs out there thinking about a dart at the dartboard and picking their stocks that way. We're talking about some of the top firms also have this exact same problem.
Absolutely. So again, organizations are made up of people, and people fall victim to the same issue, whether they're professionals or amateurs. So long-term capital management back in the 90s, classic example of just thinking too much of themselves, not appreciating the risks that they were taking, and that ended poorly. Lehman Brothers, Bear Stearns, it's a long list.
Oh, there's a great examples right there that not just affecting their own clients, but the economy as a whole.
Absolutely.
Too. So now, let's say that we might suspect that we're a little too aggressive, too happy with what we're doing, thinking that we're the master of the universe. What would be the way to know that?
So a couple of red flags to look for, whether you're evaluating your own portfolio or you're working with a professional and trying to evaluate what they're doing, are going to be lack of diversification. So in the late 90s, people thought they owned 5 technology stocks, that they were diversified. Now that ended badly. Making big bets on risky investments with the idea that somehow the market's mispricing risk, and it's much less risky than it appears to be. So the example there is people that bought 15 pre-construction condos down in Miami, thinking God's not building any more oceanfront real estate. That ended badly, and then too much trading. Too much trading. There's clearly, the research shows, when investors, both amateurs and professionals alike, trade too frequently, that eats away at returns.
So our day traders, take note of this. That's probably not where you want to be.
Absolutely not.
So finally, some tips maybe looking forward.
Yeah, so I think things to help avoid falling into this trap are going to be to first have a plan. To have a well thought out plan that you put together, absent emotional impact, is the first step. Then sticking to that plan, so when the markets get choppy, as they always do from time to time, to stick with that plan, and then sharing that plan with somebody, having an accountability partner in some ways. So that could be a spouse, a friend, a coworker. I don't know that it really matters who it is.
Well, an investment club may be a great way to go.
That's a great example. I'm in the professional business, so working with an advisor, that's part of what we do with our clients. But sharing that plan with somebody helps you stick with the plan.
Mark, thanks for joining us today.
You're welcome. Thanks for having me.